Hey folks, welcome to the Pipnotic Symposium on the 17th of November 2025. I'm currently doing this video from the Faroe Islands. I'm up here visiting my son. It's a really pretty place. It's bloody cold. It's getting close to about zero. And just looking out the window now as I record, I can see the waterfalls slowly turning to ice and sludge coming over the rocks instead of flowing water. It's kind of funny to see the transition from non-freezing to freezing, but it is really cold and it's really windy. It's crazy. It's absolutely insane here, and there aren't any trees, which is kind of remarkable. It's very funny. That's the first thing you notice, is there are no trees anywhere. Anyway, so today I just want to talk a little bit about this algo, and something that I wanted to illustrate last week was this whole concept of fiddling with trades, and I did it, and I made a couple of comments, and I just wanted to focus on that. And the reason it's a really bad idea to fiddle with trades is that you need the software to run. So you write a piece of code that can analyze a lot of data and make decisions based on what the data is showing in directional bias or whatever it is that the software is supposed to do. Then you have to leave it alone. If you're going in constantly in your moving stops and fiddling with the trade, taking profits, moving stops, things like this, well, then you're not trading the algo, you're trading your own discretion, which is not what we need. So what we need to do is we need to just leave it alone. We have to get out of the way. And I showed this last week where I was fiddling with trades, and this is just something you shouldn't do. Okay, so what we're going to do this week is I've made a few updates, and I can show you what those are. So essentially what we've got is a piece of software that runs and makes trading decisions based on a few different things. Okay, so we're looking at, first of all, we're looking at Hearst. This is to identify the regime of the data, which essentially means, are we mean reverting? Are we exhibiting kind of random walk behavior, which means we're neither going higher consistently or lower consistently, or anything else? We're not doing mean reversion. We're not trending. We're just kind of exhibiting random movement. Or are we trending either higher or lower? And this is what we're using to help us understand the regime of the data. Okay, and then the most important part is the stop losses and the risk mitigation. Essentially here, where we have our initial stop loss, which is 4 times ATR. The target is 2 times that. We're using trailing stops. Yes, the size of the trailing stop is the same as the initial stop loss, and we want to move the stop loss to break even at 2 times ATR. Okay, and I've made another modification to the algo, which I wanted to do again before we get too far into our sample size. And I mean, if the Hearst is entering based on a value like we have set here, which is 0.6, wouldn't it make sense to get out of the trade if the value goes below 0.6? Because if the whole premise for entering the trade is we are in a trending market, then there's no need to continue to trade a trending market if the regime has shifted into something that is resembling more Brownian motion or mean reversion, because this is a momentum strategy. So what I've done is I've built in to this algo some checks that's constantly calculating the Hearst, and if the value of the Hearst goes below the initial criteria for entering either a long or a short, and then it closes the trade. Because essentially this would mean that, let's say we have price and it's doing this. Let's say that we got into the trade here. And if prices up here begin to kind of exhibit non-trending price behavior, well, then we want to get out of the trade, because this just means that the whole premise for the long or the short has changed. And so I've added that as well. And so that is also running now. And so now we are going to leave it. We need a sample size. We're going to start with 50 trades, and we don't care if we get 50 winners or 50 losers. Let's say we go for 50 trades. Okay, this is the target. And then we have, for example, 1, 2, trade 3, trade 4, all the way down to 50. Okay, so if this is a winner, a loser, 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 blah, blah, winner, for example, then we're going to look at all of these trades and we are going to assess why they lost. Okay, and this is really, and why the winners won. And this is really important because it enables us to identify the similarities between the winners and also the losers. What do they all have in common? Why did all of these trades lose? And it could be something like, well, the stop loss choked the position. Okay, we kept moving it up way too quickly, so when price came down, as it normally does, before it continues higher, we got out of the trade there at a small profit or at a loss. And this is detrimental for the whole model. We want the trade to continue to work, but we can't do that if the risk mitigation functionality keeps choking the trade. This is really important. Okay, so we essentially need to establish a sample size where we have data that tells us why these trades were opened either higher for buys or for sells, and also if they were winners and losers. Okay, and then when we're done, then we can analyze this trade sample and begin to draw some conclusions. So this is what we are setting out to. And currently, the algo is running. It's doing fine. You can see here we got into a trade this morning. The initial stop was down here, and it moved the distance from the entry, which is at the end of this white bar here, to the highest high since the entry, and it's moved the stop a little bit higher, so we've removed about this much in risk, which is essentially what we had here in profit. So the stop loss has been moved. So we want to do this, but we want to be careful doing it. And I think what we're doing now is reasonable. Okay, because if price manages to move above this high here, well, then we have protection here, and so it makes sense to bring the stop up even further. Okay, so this is what we're going for, and we have our target up here, and we don't care as long as prices kind of keep going. At some stage, the stop loss will keep getting moved up, and then price will hit it and stop us out. But that's okay. We just need the experience. We need the market time on the algo. So this is what we're waiting for now. Okay, so anyway, I'll check in again in a few days. But until then, take care and send any questions in you may have. Thanks.